First, we had SVB on Friday, then Signature Bank out of New York on Sunday. And as a result of this and other banking turmoil, we have seen the metals prices explode. In fact, silver has gained nearly 7% as I'm recording this video just today alone. And I want to get more info on that. So we are going to get one of my favorite guests on the channel, James from SD Bullion. He certainly is going to have a lot of insight for us. So stick with me. James, welcome to the channel again. And what the heck is going on?
Yeah, this was obviously a huge story this past Friday. We do a regular weekly update on our YouTube channel, and I made a video about the Silicon Valley Bank failure on Friday. Didn't really do any type of guessing as to what was going to occur, but surprise, surprise, the Feds come in, bailed them out on Sunday. But it was a major. It is still a major news event, and it's still a problem. And you can see the banks are obviously trading down. The stock prices of a lot of banks have gone down. I personally have an issue with one of the banks that I use. I have to actually transfer a lot of fiat currency out of it because it looks like it's one of those banks that's suspect. And I don't study its financials like normally do. And just from watching its stock price, you can tell they're exposed to something. It was one of the fastest movers downwards. So after this call, I'm going to be transferring some money out of that place. And it's real bad when you get the quintessential CEO, letterhead email where he says everything's good. We got X amount of assets. That's when you got to panic first. In this type of situation, he who panics first is one who usually gets out first. So you got to move quick, because I assume most of the account holders at this bank are totally clueless. Probably 90, 70, 80% of them don't know that the stock price has plummeted as much as it has. That's usually a tell that something's really wrong.
Yeah, that's scary you say that when you get the letterhead from, the CEO of the bank or the head of the bank. I mean, that's usually a sign they're trying to calm people down because people know something's coming. And I think the majority
when they say don't panic, it's time to panic.
exactly. So, what's going on with metals prices? I mean, obviously metals looked at as a safe haven, gold and silver. We've seen a huge jump, especially in silver. So silver's up almost 7%. Gold's up a couple points as well. Do you think that's a lot to do with what's going on?
Sure. You have a situation now where you had I believe the two-year U.S. two-year note had gone down almost 100 basis points in a short amount of time, and literally fell off a cliff. So algorithms are set up, I think, a lot of times where interest rates on those 2 years or 10 years or what have you, if they start falling off cliffs, it tells the algorithm, various hedge funds or what have you, to go out and buy COMEX, gold, silver, whatnot. So I think a lot of that has occurred throughout the trading day today in the Western hours. Overnight in Asia, it didn't move all that much. People were a little bit underwhelmed by the move in Asia over this past night. But obviously when COMEX opened up, we saw bullish price action for gold and silver. And now, we're going to have to get through 1900 gold and, see how that performs. It's got to get back toward 1930, 1950. You clear 1950, and then you're going to make a run probably again toward the nominal record price highs again. And, third time's the charm. More or less, this might be the fourth time. I have to go back and look at the charts, but at some point we're going to break through the nominal price high. That will eventually become the support level. And that's where the mania phase of this bullion bull market really kicks off. Once it becomes very common for you to go on CNBC or Bloomberg and every week someone's talking about precious metals or miners, that's when you start to see the media exposure, and then the higher net worth inflows of capital will start coming into this sector more and more. And so, yeah, this is huge news. It's a huge catalyst. When you have a situation that looks like the precipice of a 2008 global financial crisis starting up the second half, they basically said time out for the last 15 years. So yeah, for the last 15 years, they've been doing all types of exotic things like negative interest rates, zero interest rate policies. I mean, you have interest rate policies that have gone to 5,000-year low levels, 5,000-year low levels. I mean, insanity. You have zombie companies, zombie banks that have more or less thrown out the accounting rules of mark-to-market basis and just come up with mark-to-model basis, which is, I mean, it's flagrantly wrong in principled financial way of doing business. And so, we have a comeuppance coming here. And the question is, how do the dominoes fall? How did this happen? But this is a big domino this past Friday. And so it did not surprise me this past weekend to see the biggest sales we've had in 2023 and 2022 for silver and gold. And so, to see people buying bullion when banks are failing is a reminder of how I cut my teeth in this industry when I first got into it in 2008 in the global financial crisis. I mean, at that point you had 30, 40 banks in the United States fail, and then all the bailouts that followed. I mean, that's more or less what we're looking at.
I mean, we've seen two already that have been shut down. Do you think more are coming? And you don't have to
Yes.
say who or when, but
No, I'm not going to speculate on who or when, but I mean, you have a situation where the FDIC already showed the fact that the number of their problem bank lists has grown to 150. The FDIC got caught in a meeting at the end of last year talking about bank bail-ins amongst a whole bunch of people. The video was recorded and spread out all over the internet. Everyone who's on and queued and looking at this information knows about that meeting that happened. It was pretty damning. They were pretty explicit. A number of experts talking about the fact that bank bail-ins are inevitable. And then the other thing is the FDIC has 150 banks growing in their problem list. I think they shrunk it down this past quarter, probably because people were pointing it out. They want to kind of keep it quiet. But they also had this unrealized loss figure that sits there that's blown out in the last year because all these banks owned lower interest rate bonds and various, treasuries and notes, et cetera. And, the interest rates have climbed since. So unrealized loss, meaning they didn't sell those bonds yet at major losses, but they're looking at nearly $1 trillion in losses. I think the last number was like 620 billion collectively amongst the banks. And what you saw with SVB was simply a bank run, mainly by companies. Peter Thiel put out, the word that he was getting his currency out, and so all these other people just followed him. And so essentially, they had to sell all these bonds at major losses. And then, obviously, when you sell at major losses and you have a bank run, that's what ends up happening. Your bank fails. So essentially, the issue that Silicon Valley Bank found itself in, which is kind of unique, but it's still system-wide. I mean, you have a bunch of banks that are looking at potential unrealized losses on the bonds that they bought at much lower interest rates in the last year or so. And so I think the FDIC reported that nearly $1 trillion in unrealized losses, about 620, 670 billion, depending on the quarter you look at, of bonds held collectively by the banks and thrifts in the United States were underwater. And SVB, Silicon Valley Bank, had a major run from companies who did a bank run. Basically, Peter Thiel and a whole bunch of other Silicon Valley people started pulling their currency out of that bank. 97% of the customer base was companies mainly, and mainly tech companies. I think only 2.7% at the end of last year was just regular customer deposits. So it was mainly a run of major tech companies pulling their funds out. And so Silicon Valley Bank had to sell a lot of the portfolio bonds that they owned at much bigger losses. And so essentially that's why you have bank failures. But that's simply one example. I mean, there's many banks out there that are in trouble and that look bad. And I mean, I'll suggest one for people to keep an eye on, which is a major bank. The biggest and most important banks that you need to really stay focused on failure-wise are the global systematic important banks. And that is a GSIB defined by the Financial Stability Board, which is the Bank for International Settlements policy board for understanding which banks pose the biggest systematic risk globally to the financial system. There's a list of roughly 20, maybe 15 of them all around the world, mainly in the United States, but one that's been really hurting their stock price lately has been Credit Suisse. Now, Credit Suisse's stock price is like $1. It's like $2.70. It might be lower today, but I mean, that was hundreds of dollars back during the 2008 financial crisis, and it's only precipitously gone down. And every time we have throws in the banking system, that stock tends to go down further and further. And it's really a question of, okay, well, when is that? I mean, obviously it's going to either get bought by someone else or, God forbid there's a failure. The issue is amongst those GSIBs, those global systematically important banks, they have a whole bunch of derivative counterparty bets that if one fails, it sets off this chain reaction that could really make a major crisis unfold, not merely from that one bank, but a set of dominoes falling. And that's the real issue that you're looking at. You're not looking at simply Silicon Valley Bank. That's not the threat. The threat is one of these major banks going down and really causing chaos in the financial industry at large around the world.
So what happens, let's say one of those GSIBs fail, what happens from there? Is you said it starts the domino effect.
Yeah. In late 2014, the G20 got together and wrote into supranational law, which means law that's above even your international, even in your intra. Even in the United States, it's law that covers the biggest 20 economies in the world, from China, the United States, all the way down, Euro, the EU, et cetera. And so it basically says that if your bank is a GSIB and it fails, that's a bank bail-in, essentially. And so what ends up happening is, yeah, you might be insured by, say, the FDIC for up to $250K per account, but anyone who's an unsecured creditor gets to get in line. And the derivative winners, the counterparty banks that have the winning bet of that bank failure, they get to be first in line creditors. So, for instance, if JP Morgan owns a major bet that Credit Suisse is going to fail, right? If Credit Suisse fails, JP Morgan gets to eat up all of the, basically the assets, and the unsecured creditors are kind of left with nothing. And so it's really a question of, A, who are you banking with? How sound are they? Do they trade in derivatives? How exposed are they to the risk of interest rate changes, et cetera? So it's a complex question. And, basically for me, I like to keep some cash because of opportunities that come about, but I don't keep that much. And the point of it is, for most people, the best thing to do is to keep enough cash to kind of maintain your quality of life. But I would be a little bit worried at this day and age to be keeping hordes of cash in various banks, especially over the FDIC limit of 250,000, for instance.
Right. So what do, obviously we don't want to keep a whole lot of cash in banks, especially going into this situation. What does someone do? What options do they have if they happen to have a deposit into a bank that does fail?
The FDIC obviously is going to, this past weekend, they said they'd obviously cover secured depositors, meaning people who have under 250,000 in those banks. And they'll brag about the fact that no one's lost a dime as long as the FDIC has been covering their back since 1933. 1933 obviously is when they devalued gold and nationalized the gold supply, and about 27.4% of the gold actually got turned in. The rest of it people just kept, and that's why you see pre-1933 gold coins all around the United States. So remember, our forefathers, almost 3/4 of them told the Fed to take a hike, and they kept their gold, even though they outlawed it. So just remember that. The other thing is that, yeah, if you have a lot of currency and you want to keep it, I mean, you could just go buy treasuries or bonds directly from the U.S. government if you want. You don't have. You can go to the U.S. Treasury to the My account and buy a bond or a treasury note directly, and you'll yield 5-4% depending on the time. And the banks will pay you what, basis points or 1, 2, 3, 4, 5%. I mean, they're going to make a spread, obviously, and you can just jump the middleman and go directly to the treasury if you want, if you're big enough. But if you're just a regular person like you or me, just an average Joe who has 10, 20, 30 grand sitting in a bank, I mean, the key is try and find stable credit unions or places that aren't mega banks that are trading in exotic derivatives that have risks inherent to the system, and go with something a little bit more simple and sound. That's my suggestion, is just try and find, and don't go all in one basket. Maybe have multiple bank accounts, not too many, because then all of a sudden they're going to think you're laundering currency, et cetera. But maybe 2 or 3 banks is probably the right way to go.
Okay. So what about gold and silver, though? I mean, do you think people should have, obviously, you work for SD Bullion, but outside of working for SD Bullion, I mean, just, as a guy into this, I mean, exposure to gold and silver, where should we be at?
So there's different studies that have been done. I was just sending one to a reporter today who was asking for, query on gold. And so I made an email and a backlinked a bunch of reports and insights on kind of how the gold price is done versus stocks and bonds since 1968. There's a study that was done by CPM Group. Basically, 1968 through July 2020, you look back in time, throughout the 52 years that it covers roughly, it made sense risk-reward basis to have 20 to 25% allocated to gold, and then the remaining 70 or 75 to 80% allocated to S&P 500 and bonds, right? So most people would be very surprised by that. When you hear financial talking heads on, anyone who's pro gold, they always mutter like, yeah, keeping 10% of gold makes sense. That old 10% thing, it really comes from the late 1970s when gold went into a mania back in early January 1980, where it hit $850 an ounce, and literally we could have gone back on a full-fledged gold standard because the amount of gold that we have in our official reserves covered the amount of currency that we had floating around. So we literally could have gone back on a gold standard. To do that today, you got to get in the 5 figures of gold to get anywhere near that level. So we have a long way to run in this gold bull market. So the suggestion is, in your liquid net worth, you should be pretty aggressive in the amount of allocation that you put into bullion. I personally am extremely aggressive. I wouldn't suggest that for most people because I have a fundamental understanding and view. I've 15 years in this industry and understand very specifically why I'm in it and for how long likely. But for someone who's just average, or depending on your age, and you don't feel like waiting out 5-10 years that it could take for this totally to play out, I mean, a prudent allocation is 20% of your liquid net worth sitting in bullion, mixed amongst gold and silver. And it depends on your question. I would ask someone, if you're thinking about gold versus silver, you got to ask yourself, what's the most important thing? If preservation of wealth is first and foremost, you definitely need an allocation to gold. If the enhancement of your wealth position is important to you too, then you should be aggressive in allocating to silver as well, because silver, $24 an ounce in bullion is, I mean, it's going to be looked back as absolute dirt cheap. I think ultimately bullion goes to 3 figures an ounce before this thing all is said and done.
Wow. Okay. Well, I would love to see for that happen. That happen. Although I wish I would have bought more yesterday, because I'm one of the people that went out before the markets opened up and bought it. And then you had mentioned earlier about how it was kind of weak over in Asia, and I was watching those markets, and even I was kind of disappointed. Like, I really expected like some significant movement, and then I woke up this morning. I'm like, oh, there it is. So
yeah. And then if you remember back March 2020 during the COVID crash of spot price, I mean, it took a bunch of weeks eventually for not only the shortages to start popping up, the premium widen gap between spot and the bullion market. If we keep having bank failures or, risks of bank failure, you're going to see that again, coming again. And I think the acute phase, when this is all said and done, when it plays out, it's going to be one of those situations where you go to buy bullion and you just can't get it at a reasonable price, in size, at any chance of delivering it within a reasonable time. I mean, if Peter Thiel and his rich Silicon Valley buddies can do a bank run like that of a bank that's got 200 billion in assets, think about what happens when the high net worth investors in the United States start worrying about the US dollar storing, their purchasing power. I mean, that's really where this ultimate end game goes. You get a run on bullion. And when that happens and you go to look for bullion, you can't find it at any reasonable prices and any reasonable size. So what you end up having to do is buying underperforming proxies like unsecured GLD, unsecured ETFs like IEU, all these terrible proxies that are going to underperform versus bullion, or risk-laden miners with energy costs going up, geopolitical uncertainty, underperformance versus bullion since 2011, and I don't see that stopping until gold goes into a manic exponential phase. So there's a lot of options out there. There's a lot of arguments people might make, why they trade miners over bullion, but the data is proven, and since 2011, they've underperformed bullion. And I expect that'll continue until gold goes into an exponential price climb like it did in 1980. It was only until 1982, 83, 84, 85 where gold miners outperformed bullion. And during the 1970s and overall, bullion outperformed gold miners throughout that entire decade.
Well, that's pretty much all I had, but I do want to say and let everyone know that we will absolutely be following this. And if you don't mind, here in a few weeks or maybe a month or so, I'd love to have you back on, just kind of get an update. Is that something you'd be okay with?
Yeah, of course. It's good to talk to you.
So guys, that was James Anderson from SD Bullion, and it was a pleasure to have him on. Of course, we'll have him on in a few weeks or maybe about a month from now, so make sure you subscribe so you don't miss out on that video, and I definitely will look forward to seeing you in future ones. If you haven't seen this video up here, that's the next one you should watch right now. Thank you so much, and we'll see you next time.